Okay, so, you know, maybe you're looking at like a company to invest in, or you're just, trying to understand your own company's finances, like how healthy is it really? Or maybe you just want to like finally get a grip on how this whole corporate finance world works.
Yeah, I mean, it can seem pretty intimidating at first, all
Totally.
these terms and rules and stuff.
Right.
But once you get the hang of those core principles, it's actually pretty amazing.
It
You start
is.
seeing like the bigger picture. You can analyze businesses and decisions in a whole new way.
So that's what we're doing in this deep dive. We're going deep into intermediate accounting. We've
Exactly.
got a bunch of materials we've gathered, and they cover like a really wide range of topics.
Yeah, from like revenue recognition to pension obligations to how to actually make sense of financial statements, like the whole shebang.
It's a lot, but we're going to break it down for you.
Yeah.
We're going to pull out the most important stuff, the practical knowledge you can actually use, and we're going to make it clear no matter what your background is.
You know?
Okay, so first up, let's talk about long-term liabilities, starting with bonds.
Okay, so think of long-term liabilities as debts that a company doesn't have to pay back right away.
Okay.
We're talking longer than a year or even longer than their normal operating cycle, whichever is longer.
Right.
Bonds are a classic example.
Right.
Companies use them to borrow money from lots of investors.
Got it. And so every bond has like a basic structure, right? There's that principal amount, which you might also hear called the par value or face value.
Right.
That's basically the amount the company promises to pay back when the bond reaches maturity.
Exactly.
And then you've got the interest, which is set by what's called the contract rate or nominal rate that's stated right there on the bond certificate.
Exactly. Now, let's say the interest rate on the bond, that contract rate, is the same as what the market wants for similar bonds at that time. That's the market rate.
Okay.
In that case, the bond will be issued at par value.
Makes sense. So let's say Greenfield Corporation issues a bond for $100,000 face value with a 10% annual interest rate. If the market interest rate for similar bonds is also 10%,
Right.
Greenfield's going to sell that bond for $100,000, right?
Exactly. But things get a little more complex when the rate the company's offering on the bond, that contract rate,
Right.
doesn't match up with what the market's paying.
Yeah. So what happens then?
Well, that's when we see bonds being issued at a discount or a premium.
Okay.
So if the market rate is higher than that contract rate, investors are going to want a lower price, a discount, to compensate for those lower interest payments they'll be getting.
So that discount's like making up for the fact that they could be getting a better return elsewhere?
Exactly. Now flip that around.
Okay.
If the contract rate is higher than the market rate, investors are happy to pay more than the face value.
Okay.
That's a premium because they're getting a sweeter deal on interest payments.
Got it. And then there are those deep discount bonds you hear about sometimes,
Right.
or zero coupon bonds.
Yeah, those are interesting.
They don't pay any regular interest, right?
Right. Instead, they're sold at a much lower price up front, a deep discount, and the investor's return comes from getting that full face value when the bond matures.
So they're basically betting on that future payout.
Exactly. And there are other types of bonds too, like commodity-backed bonds.
Right.
Those can be redeemed for a specific commodity, like oil or gold, instead of cash.
Interesting. And what about callable bonds?
Those give the company the option to buy back the bonds before they're supposed to mature.
I see. So if interest rates go down, they can basically refinance.
Exactly.
Yeah.
Now, what happens when a bond is sold between interest payment dates?
Yeah, good question.
Well, interest on bonds accrues every day. So if a bond is sold, let's say 2 months after the last interest payment, the seller is owed the interest that's built up over those 2 months.
Okay.
The buyer essentially pays that accrued interest to the seller.
So it's not like an extra profit for the company that issued the bond.
Right. It's just settling up the interest earned to that point. Now, how do we actually figure out the price a bond will sell for?
Yeah, that's the big question.
It all comes down to the time value of money. The selling price of a bond is the present value of all those future cash flows it'll generate. That means the present value of that principal repayment at maturity plus the present value of all those regular interest payments.
I see. So you're basically figuring out what those future payments are worth in today's dollars.
Exactly. Because $100,000 10 years from now isn't worth $100,000 today.
Right. And there are also costs involved in issuing bonds, right?
Yeah, things like printing the certificates, legal fees, all that stuff.
Right.
Those bond issue costs are usually treated as an asset, and then they're amortized.
Amortized.
Yeah, meaning they're spread out as an expense over the life of the bond.
Okay, so it's like spreading out that initial cost over the whole time the bond is in existence.
Exactly. And we should also mention take-or-pay contracts.
Take-or-pay contracts.
These are agreements where a company commits to paying for goods or services, even if they don't actually take them.
Interesting. So why would they do that?
Well, it can be a way to secure a steady supply or to get a favorable price.
Okay.
And for the supplier, it can be a great source of financing
How so?
because they have that guaranteed revenue stream. They can use it to get loans or other forms of credit.
So it's like having a really reliable customer.
Exactly. Now, when you're looking at a company's financials, pay close attention to the footnotes.
The footnotes.
Yeah, they'll give you the details on their long-term debt obligations, like interest rates, maturity dates, any special features or conditions.
So the footnotes are where the real story is.
Often, yeah. Okay, now let's talk about long-term notes.
Okay, so how are those different from bonds?
Well, they're similar in that they represent a debt that lasts more than a year,
Okay.
but they're usually issued to a smaller group of lenders, often banks or other financial institutions, not to the public, like bonds.
Got it. And just like bonds, they can be issued at face value at a discount or at a premium.
Right, and one interesting thing with notes is you have these non-interest-bearing notes.
Non-interest.
Yeah, it sounds like there's no interest involved, but they're actually issued for a price way lower than their face value.
Okay.
The difference between the cash received and that face value, well, that's essentially the interest expense. It's just hidden.
So it's like they're building the interest into the price up front.
Exactly.
Yeah.
So, for example, a company might issue a $100,000 non-interest-bearing note to buy a piece of machinery,
Okay.
but that machinery is only worth, say, $60,000.
Right.
That $40,000 difference, that's not free money. It's the interest expense. It's just spread out over the life of the note.
Okay, so how do you account for that hidden interest over time?
Well, you have to amortize it, recognize it as an expense.
Mhm.
Each period, the preferred method is the effective interest method.
Effective interest method.
It gives you a more accurate picture of the cost of borrowing.
Okay, and what if a note comes with some special perks or conditions?
Ah, good point. Sometimes a lender might get a lower interest rate,
Okay.
but in exchange, they agree to buy goods from the borrower at a discount. So in that case, part of the money from the note isn't really for the loan itself. It's like prepayment for those goods.
Okay.
That part gets recorded as unearned revenue, a liability on the borrower's balance sheet.
I see. And then as they sell the goods, that unearned revenue turns into actual revenue.
Exactly.
Yeah.
So the key takeaway here is that understanding how to account for these long-term notes, especially when there's hidden interest or these special deals,
Right.
it's really important for getting a true picture of a company's debts and how they recognize revenue.
Absolutely. Okay, let's shift gears and talk about stockholders' equity, starting with how stock is issued.
All right, so this is all about how a corporation raises money by selling ownership in the company.
Right.
The two main types of stock are common stock and preferred stock.
So common stock is like the basic ownership, right?
Yeah, common stockholders typically get voting rights.
Okay.
Preferred stockholders usually have some advantages, like they get priority when dividends are paid out.
Got it. And both types can have a par value, right?
Right? Par value is just this arbitrary amount assigned to each share.
Okay.
It doesn't necessarily reflect the actual market value of the stock.
Interesting. So when a company issues stock, they could receive the par value more than the par value or even less.
Yeah, that's right. Selling stock below par value isn't common, though.
Why not?
Well, in some places, it can create a contingent liability for the shareholders. If the company runs into financial trouble, creditors might be able to go after the stockholders for the difference between the par value and what they originally paid.
Oh, wow.
To avoid that, many states let companies issue no par stock.
No par stock.
Yeah, when they sell no par stock, all the money they get goes into the common stock or preferred stock account.
Okay. And what about stated value?
So sometimes the board of directors will assign a stated value to no par stock.
Okay.
For accounting purposes, it's treated pretty much the same as par value.
Got it. Now, what about stock subscriptions?
So stock subscriptions are agreements where investors promise to buy a certain number of shares at a set price. They often pay in installments over time.
Right.
Now the company doesn't issue the shares right away.
Okay.
Instead, they use a temporary account called common stock subscribed or preferred stock subscribed.
Right.
That account gets credited with the subscription price. Once the investor pays in full, that account is closed, and the actual common stock account is credited along with any extra paid-in capital.
Okay. That makes sense. And what happens if a company issues stock in exchange for something other than cash, like a piece of equipment?
Good question. In those non-cash transactions, they have to record the transaction at the fair market value.
Fair market value.
Yeah, either the stock they issued or the asset they received. whichever is more clearly determinable.
So they're basically making sure the value is recorded accurately.
Exactly. And then we have treasury stock.
Treasury stock.
This is when a company buys back its own shares from the market.
Okay.
It's not considered an asset, though.
Really? So what is it?
It's a reduction in stockholders' equity. When they buy back those shares, they debit a treasury stock account, and when they resell them, the difference between the original price and the resale price usually goes into separate paid-in capital accounts related to treasury stock.
I see. But what if they sell it for less than they paid for it?
If that happens, and there's not enough in the paid-in capital from treasury stock account to cover the difference they have, to debit retained earnings for the rest.
Retained earnings. Okay, so what about donated stock?
Donated stock is when shareholders give shares back to the company.
Okay.
It's usually accounted for by reducing both the outstanding common stock and the related paid-in capital accounts, like the shares were retired. This is often called the par value method.
Par value method, got it. And lastly, what about stock assessments?
These are rare, but it's when a company asks its stockholders to pay extra on shares they already own.
Okay.
If the stock was originally issued at a discount, any assessments go towards offsetting that discount. And if it wasn't issued at a discount, the assessment goes into a separate paid-in capital account.
So the big picture with stock issuance is...
Understanding the different ways companies can issue stock and all the rules that apply.
Right.
It's crucial for understanding the stockholders' equity section of the balance sheet and the company's ownership structure.
Okay, now let's dive into another key part of stockholders' equity, retained earnings, and dividends.
Retained earnings are essentially all the net income a company's ever made minus any dividends they've paid out.
Okay,
It's a profit they've kept and reinvested.
so the main thing that affects retained earnings is net income.
Right. Profits make it go up, losses make it go down.
Okay.
Other things that can affect it are prior period adjustments. Those are corrections to errors from previous years.
Right.
And, of course, dividends. Those are payments to stockholders from the company's earnings.
Okay, let's talk about cash dividends.
All right, so with cash dividends, there are 3 key dates:
Okay.
declaration date, record date, and payment date.
Declaration dates when the company's board of directors says, hey, we're going to pay a dividend.
Right, the record date is the cutoff date to determine which shareholders are eligible to receive the dividend.
And the payment date is when the company actually sends out the checks.
Right now, from an accounting perspective, there's a journal entry on the declaration date when the liability for the dividend is created,
Okay.
and another on the payment date when the cash goes out.
But nothing on the record date.
Right. So if you buy shares right before the record date, you get the dividend, even if you sell them right after.
Interesting. So what about dividends that aren't paid in cash?
You have property dividends. Those involve distributing assets other than cash.
Okay.
Could be shares of another company or even physical assets.
Wow.
Before they distribute a property dividend, they have to adjust its value to the fair market value.
Okay.
Any gain or loss from that adjustment gets reported on the income statement.
Got it. Then there are scrip dividends.
Those are basically like IOUs from the company promising to pay a dividend later, often with interest.
So if they want to distribute earnings but don't have the cash on hand,
Right.
okay, and stock dividends?
Those are when a company gives out more shares of its own stock to its shareholders.
Right.
How you account for those depends on the size of the dividend.
Okay.
A small stock dividend, usually less than 20 to 25% of outstanding shares.
Okay.
That's recorded at the stock's fair market value.
Got it.
But a large stock dividend,
More than 25%.
right, that's recorded at par value.
So for small stock dividends, retained earnings go down by the market value of the new shares.
Exactly.
And for large dividends, it's based on par value.
Now, don't confuse stock dividends with stock splits.
Stock splits.
Those increase the number of shares
Okay.
and reduce the par value per share proportionally.
Right.
But the total stockholders' equity and retained earnings don't change. It's just a paperwork thing.
Okay, so what about appropriations of retained earnings?
That's when a company sets aside part of retained earnings for a specific purpose,
Like,
like maybe a future expansion or a big project.
so it's like earmarking funds?
Right, but it doesn't actually restrict the company's cash.
Okay, and what about quasi-reorganization?
That's a procedure companies can use to wipe out a deficit in retained earnings.
Okay.
Usually after a period of losses, it can involve revaluing assets or restructuring equity accounts.
Interesting. And liquidating dividends.
Those are different from regular dividends. They represent a return of the shareholder's original investment,
Okay.
not a distribution of profits.
So they're accounted for differently.
Right, you reduce paid-in capital accounts instead of retained earnings.
Got it. And finally, prior period adjustments.
Those are for correcting big errors in previous financial statements.
Okay.
They're made directly to retained earnings after adjusting for taxes.
So the key takeaway with retained earnings and dividends is
A healthy and growing retained earnings balance usually means the company's profitable and reinvesting its earnings well.
makes sense. And understanding how they handle dividends gives you a look into how they share profits with owners.
Exactly. Okay, let's move on to dilutive securities and how they affect earnings per share, or EPS.
Dilutive securities.
Yeah, things like convertible bonds, convertible preferred stock, and stock warrants.
Okay.
They have the potential to increase the number of outstanding shares in the future.
Which could dilute earnings per share.
Right, let's start with convertible bonds.
Okay.
They often offer a lower interest rate than regular bonds with similar risk,
Why is that?
because investors are willing to accept a lower return in exchange for the option to convert those bonds into stock later on.
So it's like they're betting on the company's future success.
Exactly. Now, when convertible bonds are issued,
Okay.
they're treated just like any other bond. But if bondholders decide to convert them to stock,
Right.
the company takes the bonds off the books and issues new shares.
Okay.
And those shares are usually recorded at the book value of the bonds that were converted.
Book value. Okay. And what about stock warrants?
Those are certificates that give the holder the right to buy a certain number of shares at a fixed price.
Within a certain time frame.
Right, they're often issued with bonds as an extra incentive.
Okay.
The key difference between convertible bonds and bonds with warrants is with convertibles, the bondholder gives up the bond to get the stock.
Okay.
With warrants, they keep the bond and pay extra to buy the stock.
Got it. And when bonds are issued with detachable warrants, the money from the sale has to be split between the bonds and the warrants.
Right, usually based on their fair market values at the time of issuance.
Okay.
There are a couple methods for that, the proportional method and the incremental method.
Makes sense. And then there are employee stock options.
Those give employees the right to buy company stock at a set price.
After a certain period.
Right, it's often part of their compensation.
Okay.
The company has to recognize that as an expense over the time the employee works there.
Usually the vesting period.
Exactly. Okay, so earnings per share EPS, there are two types, basic and diluted.
Okay.
Basic EPS is pretty straightforward. You take net income, subtract any preferred dividends, and divide by the average number of shares outstanding.
Got it.
Diluted EPS is a bit more conservative.
Okay.
It takes into account the potential impact of all those dilutive securities we talked about.
Right.
Convertibles, options, warrants, the whole shebang.
So how do you calculate that?
Well, for convertibles and convertible preferred stock, we use the if converted method.
If converted.
Yeah, we basically pretend those securities were converted to common stock at the beginning of the period.
Okay.
So we add back the preferred dividends or interest expense that would have been saved,
Right.
and we increase the number of shares in the denominator.
Okay. For options and warrants, you usually use the treasury stock method.
Right, we pretend the company uses the cash from those options, or warrants being exercised to buy back shares in the market.
At the average market price.
Exactly. The net increase in shares gets added to the denominator.
Okay, now not all dilutive securities actually reduce EPS, right?
Right. If including a security would make EPS higher than the basic EPS,
Okay.
it's considered anti-dilutive, and
Yeah.
we don't include it.
So we only include the ones that actually dilute earnings.
Exactly. There's also the 3% test.
3% tax.
Yeah, it's a rule of thumb that says if a security would change diluted EPS by less than 3%,
Okay,
we can probably leave it. It's a materiality thing.
got it. And when we're figuring out the average number of shares, we have to consider stock dividends and stock splits.
Yes, we treat those as if they happened at the beginning of the period.
Okay.
So we adjust the number of shares retroactively.
Okay, so what's the big deal with diluted EPS?
Well, it gives you a more realistic view of a company's earnings potential because it considers that potential increase in shares.
Right, so it's not just looking at the current picture.
Exactly. It's looking ahead.
Okay, let's talk about investments.
All right. So investments can be short-term or long-term.
Right.
Short-term investments are held for a year or less.
Okay,
Long-term ones are held for longer than a year.
got it. And they can be in debt securities like bonds or equity securities like stocks.
It's exactly. Now, short-term debt securities are usually recorded at cost.
Okay.
If you buy bonds between interest payments, the price includes the accrued interest up to that point.
Accrued interest.
Yeah, the interest that's already built up.
Right.
And when you get that interest payment, the part that's just reimbursing you for the accrued interest,
Okay.
That's credited to interest revenue.
Okay, so how about long-term debt securities?
Those can be a little more complex. The accounting depends on what management plans to do with them.
Okay.
If they're classified as held to maturity, they're recorded at amortized cost.
Amortized cost.
Yeah, spread out over time. But if they're classified as trading securities or available for sale securities,
Okay.
they're reported at fair value.
Okay.
And how you treat any gains or losses depends on how they're classified.
Got it. Now, what about long-term investments in stocks?
Those are interesting. The accounting depends on how much influence the investor company has over the company they invested in. If they have significant influence, usually meaning they own between 20 and 50% of the voting stock,
Okay.
they use the equity method.
Equity method. So what does that mean?
It means the initial investment is recorded at cost,
Okay.
but then the investor records their share of the other company's net income or loss on their own income statement.
As investment revenue.
Right, and the investment account on the balance sheet is adjusted accordingly.
Okay. And when the other company pays dividends,
The investor gets cash and the investment account goes down
got it. And if they own less than 20%.
and don't have significant influence.
Right.
They usually use the cost method.
Cost method?
Yeah, the investment stays at its original cost on the balance sheet
Okay.
and they record dividend income when they receive it.
Simple enough. Now, what about stock dividends on investments?
Those aren't treated as income. The cost of the investment stays the same,
Okay.
but now it's spread out over more shares.
So the cost per share goes down.
Exactly, and if they get stock rights,
Stock rights.
those give them the option to buy more shares at a certain price.
Right.
The cost of the investment has to be split between the original shares and those rights
Oh.
based on their fair market values.
Makes sense. And lastly, life insurance policies.
Ah, yes. Companies sometimes take out life insurance policies on key employees.
Okay.
The cash surrender value of those policies is considered an asset.
Okay. So the key takeaway with investments is
Understanding how to account for short-term and long-term investments, and especially how that level of influence affects the accounting for stock investments.
right.
It's all crucial for analyzing a company's financial strategies and how well they're doing.
Absolutely. Okay. Let's tackle revenue recognition.
All right, so the basic idea is that revenue should be recognized when it's earned and realized or realizable.
So usually when goods are delivered or services are performed,
Right, but there are some situations where it might happen before or after delivery.
like in long-term construction projects. Exactly.
Hmm.
They might use the completed contract method, where they only recognize revenue when the whole project's done,
Okay.
or the percentage of completion method, where they recognize it gradually as the project goes on.
Based on how much they've completed.
Right. And sometimes revenue might be delayed until after delivery.
Okay.
Like with the installment sales method, they recognize profit as they collect cash from the customer.
So when there's uncertainty about getting paid.
Exactly. And if a customer can return goods,
Right.
they generally shouldn't recognize revenue until they're sure about the returns.
Makes sense. And what about commodities?
Some commodities have really stable prices and are easy to sell.
Like gold or agricultural products?
Yeah, in those cases, they might recognize revenue when production's finished, even before they've sold anything.
Interesting. So the main point about revenue recognition is...
It's super important because it directly affects how profitable a company looks.
Right.
When they recognize revenue can really change their financial statements.
Okay, so let's move on to accounting for leases. Leases can be tricky.
Yeah, they seem pretty straightforward at first.
Right, but there are a lot of nuances. So a lease is basically an agreement where one party, the lessor, lets another party, the lessee, use an asset for a certain time
Okay.
in exchange for payments.
Right.
There are two main types, operating leases and capital leases. Although under newer rules, they're called finance leases and operating leases.
We'll stick with the old terms for now since that's what our sources use.
Sounds good. So a lease is considered a capital lease if it looks like the lessee is basically taking on the risks and rewards of ownership.
Okay, so what are some signs of that?
Well, if ownership of the asset transfers to the lessee at the end of the lease,
Okay.
or if there's a bargain purchase option where the lessee can buy it for a really low price,
Right.
or if the lease term is for most of the asset's useful life, like 75% or more,
Okay.
or if the present value of the lease payments is pretty much the same as the fair value of the asset, like 90% or more.
So if any of those are true, it's a capital lease.
Right. If none of them are true, it's an operating lease.
Okay, so how's the accounting different?
With operating leases, it's simple. The lessee just records the payments as rent expense.
Okay.
The asset stays on the lessor's balance sheet.
Got it.
But with capital leases, it's like the lessee bought the asset.
Okay.
They record both an asset and a liability on their balance sheet.
So they have the asset, but they also owe money for it.
Exactly. They depreciate the asset over its useful life or the lease term, whichever shorter,
Okay.
and the lease payments are split between interest expense and principal reduction.
Like a loan.
Exactly. And the lessor's accounting depends on the type of capital lease.
There are different types.
Yeah, direct financing lease and sales type lease.
Okay.
In a direct financing lease, the lessor's profit is mostly the interest income.
Okay.
But in a sales type lease, they also recognize the profit or loss on the sale of the asset.
So it's like they actually sold it.
Right. And there are also sale-leaseback transactions.
Sale leaseback.
Yeah, where a company sells an asset and then immediately leases it back from the buyer.
Okay.
The accounting for that can get really complex.
So the key takeaway with leases is
Understanding the different types and how they're accounted for is really important for figuring out a company's debt levels, their assets, and their real obligations.
right, because those capital leases can really impact the balance sheet and income statement.
Exactly.
Okay.
Let's talk about the statement of cash flows.
Statement of cash flows.
Yeah, this statement shows all the cash coming in and going out of a company during a specific period.
Okay.
It helps you see how liquid a company is and how well they generate cash.
So liquidity means how easily they can access cash.
Right, exactly. Now, this statement has three main sections:
Okay.
operating activities, investing activities, and financing activities.
Okay. Break those down for me.
Sure, operating activities are from the company's core business operations.
Okay.
You know, the day-to-day stuff that generates revenue and expenses.
Right.
Investing activities involve buying and selling long-term assets.
Like property, plant, and equipment or investments in other companies.
Right, and financing activities are about how the company gets and uses money.
Okay.
Things like borrowing, repaying loans, issuing stock, paying dividends.
Got it. So for operating activities, there are two methods, the direct method and the indirect method.
Right, with the indirect method, you start with net income,
Okay.
and then you adjust it for non-cash items and changes in working capital accounts.
Non-cash items like depreciation.
Right, and working capital accounts like accounts receivable and accounts payable.
So you're basically converting net income to a cash basis.
Exactly. The direct method is different. It shows the actual cash inflows and outflows,
Okay.
like cash from customers, cash paid to suppliers, cash paid to employees.
Got it. So what's the big takeaway from the statement of cash flows?
It shows you how well a company can generate cash, pay its bills, invest in its future, and return cash to investors.
So it's really important for understanding a company's financial health.
Exactly. Okay, let's move on to accounting changes and error corrections.
Okay, so sometimes companies have to change their accounting methods or fix mistakes in previous statements.
Right, there are three main types of adjustments:
Okay.
changes in accounting principle, changes in accounting estimate, and corrections of errors.
Okay, what's a change in accounting principle?
That's when they switch from one accepted accounting method to another,
Okay.
like changing how they value inventory.
Okay. And a change in accounting estimate.
That's when they revise a previous estimate based on new information.
Like changing the useful life of an asset.
Exactly. And a correction of an error is fixing a mistake in a past statement.
Like a calculation error or applying a rule incorrectly.
Right now, changes in accounting principle are usually applied retrospectively.
Retrospectively meaning?
They go back and restate their old statements as if they always use the new method.
Okay, so they're rewriting history?
Sort of, yeah. Changes in accounting estimate are applied prospectively.
Prospectively?
Yeah, they only affect the current period and future periods.
Okay.
They don't go back and change the old statements.
So it's like starting fresh with the new estimate?
Exactly. And corrections of errors are treated as prior period adjustments.
Prior period adjustment.
Yeah, they restate the affected statements and adjust retained earnings.
Okay, so why is all this important?
Because it helps you compare company statements over time.
Right.
You can see if their results were affected by changes in methods or by fixing old mistakes.
Got it. Okay, let's talk about pensions.
All right, so pensions are plans where employers provide retirement benefits to employees.
Oh, boy.
There are two main types: defined contribution plans and defined benefit plans.
So defined contribution plans are like 401ks.
Right. The employer puts money into an account for the employee. Host, speaker.